Welcome to the Real Estate Investment Hub, where you can learn how to grow, scale, and optimize your real estate portfolio through our conversations with investors and thought leaders in the real estate industry. Let's move on to the episode.
Hello, everyone. Welcome back to the Real Estate Investment Hub. Today we have Philip Ngo. Philip Ngo, right? No? Yeah, okay. Yeah. Philip Ngo from Left Side Adventures. So Philip's actually someone that I've been following personally for quite some time now. I think this was, when did you guys start? Like 2020?
I think we started following each other like in COVID, like 2021, 2022-ish.
Mm-hmm. And they've been killing it ever since. So very inspirational for sure. Philip and his two partners, they run a firm called Left Side Adventures, where they personally invest in a ton of real estate. And how many do you have right now?
I think right now we have four properties. Properties.
Amazing.
And how many units?
19 units right now.
Wow. Damn. So, guys, we're not talking about like single condos here. Mm-hmm. Philip is actually buying multifamily units, which is amazing. So I am so excited to have him on, talk to him, learn about his story. And let's go on. So, Philip, why left-sided? Tell us a story about that.
I feel like a lot of people actually don't ask this question, or they don't understand like what left-sided is, and so
it's a cool name.
Nice. It's nice to just like talk about it for once. Left Side Adventures, like left side is actually one of my partner's wife came up with it. It's like, you guys are like total dorks. You guys are very analytical, methodical people. That's the left side of the brain. You guys talk like it, so you should incorporate that. And obviously someone who's on the right side of the brain gave us the creative name of that, which I thought was ironic, I think. So left side of the brain, all of our investment decisions are said to be like based on numbers, data, analytics. We only do things based on math. And so it makes sense. Like our business partner, one of them is like a software engineer, the other one's an engineer, and I'm like the lone nutritionist.
Makes sense, yeah.
Keeping everybody healthy.
Yeah.
And are you giving your buddy's wife a bit of a royalty as well moving forward for the name?
Yeah, maybe we'll
just
see
like 10% for forever. Yeah.
Yes.
I mean, that's cool. With something like real estate investing, I think being analytical is extremely important.
Absolutely.
He comes from a very numbers background as well. Mm-hmm. I think a lot of investors, unfortunately, as we see in BC, they really invest with their heart. And that is the exact opposite of what you want, because that is exactly how you lose money.
Yeah.
And, I do follow Philip quite a bit and look at his stories and stuff. And it's always spreadsheets and everything else, which is exactly what you want. Mm-hmm. And Philip, I do actually want to dive into that a little bit with you. So you said that you're very into all the numbers of real estate. So what exactly do you guys actually look for? Let's say we walk outside today and we find a patch of dirt and there's a 20, 30-year-old multifamily on top. How would you even start being like, hey guys, maybe we should actually buy this property?
That's a good question, Chris. When you look at the, I think when you zoom out and you're looking at the macro, you obviously want to find like a good city to invest in, good state or province to invest in first. So you want to look at population growth, job growth, rent growth, appreciation trends. Like Vancouver is like fantastic for the appreciation part. And then you want to look at other things like intangibles, just to kind of get you into that city. And so that's just like high level macro, obviously. But then when you start looking at the micro of that property in itself, then those details get more interesting. It just depends on what the investor wants to look at. If you want to look at probably the thing that we're trying to focus a little bit more on lately is like the IRR, the internal rate of return, which I think is kind of like the holy grail of like what people should be looking at. It looks at appreciation, equity pay down, rent growth, future growth as well. So I think that's where we're moving towards, aside from your typical, cash on cash return. How much can you refi out? What your ROI is within 1 year, what your cap rate could be. So I think it just depends, unfortunately.
That is the weird thing about real estate investing, is that there's so many kind of golden metrics that everyone uses. I know if you talk to a lot of commercial brokers on the multifamily space, because you guys talk to a lot of those, right? It's always, this trades at an 8 cap, it's a 9 cap, it's a 10 cap, it's a 5 cap.
Yep.
But like you said, a lot of these metrics don't take a lot of different factors into account. A lot of people look at only cash on cash. You know, in
Mhm.
Vancouver, a lot of people do cash on cash. So yeah, our IRR is a really, really good one for sure.
Yeah, definitely gets very interesting. Like even
Hmm.
when you look at cap, like what does that really mean?
Exactly.
It could be more risky, it could be less risky.
Hmm.
And then some people might be looking at like this is a little bit higher level, like cap rate relative to the interest rate. Does
Oh
that
yeah.
mean
Mhm.
that's a good investment? It's a horrible investment now. So the main focus for us lately for looking at our investments is like how much capital are we leaving into the deal? Is it an appreciating market? Does it pay it for itself?
Hmm.
And we'll dive into a little bit of that later on.
Cool.
Yeah.
So okay, so let's say the three of us we go back to that plot of land. We've done the spreadsheet, and now what? And it's like, okay, so this is actually a good investment. This is something we want to put money into, and what should the three of us do next?
Um, at that point, we got to put in the offer, of course, and
Hmm.
then work with our realtor or just try to negotiate that price as low as we can based
Hmm.
on the numbers. We're gonna be very left-sided with this and just
Mhm.
put in an offer that works, especially for our numbers. If listing price is 500K, we might not go in at 500K. We just need to offer and just that plot of dirt that that used or that multifamily property
Hmm.
could work in terms of our numbers, but the seller's not going to sell it at that price. So a lot of it probably as an investor is probably a lot of like swing miss
It's
after.
always like that for us as well. Yeah.
Rightfully so. I mean, it wouldn't be a great investment unless you get to hit your numbers, right?
Hmm.
And right now, Philip, is it just the three of you that are going into these deals, or are you getting, I guess, some outside investors outside of the group?
Yeah, so lately it's only been the three of us historically, like in 2021 all the way until 2023 or
Mhm.
so. Yeah, but lately we've kind of partnered up with someone else who was in alignment with our values and everything like that, and we've kind of been talking to them about what we've been doing. So they're our first kind of like joint venture partner
Mm.
in that sense, where we're doing the work. They fund 50%, we bring in 50. Everyone has value, and we're kind of just going to hold out this property that we bought in October 2023 for the time being, and then just see how that goes.
Mhm.
We're really focusing on just trying to find the right partners if we do want to
Hmm.
partner with someone, and trying to keep it within ourselves. Like if all three of us are buying properties, it's better to, while I understand like it's better to divide and conquer, you can buy more properties with more people, but it's kind of, when I'm thinking about it, like I don't really want to own 500 or 1,000 units.
Mhm.
It's a lot of headache, lots of responsibilities. And so I think we're just like deciding and in the early phases of like, what do we really want in terms of our future lifestyle?
Mhm.
Does that
Mhm.
look like?
Oh, I think our investment approach is relatively
Similar.
similar. Number one, the more partners you bring in, the less control that you have, right? That in itself is a risk,
Hmm.
right? So keeping it within the, I guess, group is the best way forward. And
This is actually something that we've learned from talking to a lot of different developers as well.
Mhm.
Mainly a good developer friend of ours. He told us this recently, where they're currently scaling from building townhomes to building a low rise with like commercial on the bottom, so mixed use in Surrey. And I was asking him, so are you going to do a raise for this thing? Like, what's the thing, or are you just going to get a like construction line of credit, or like what's the play here? And he was saying that they do have a lot of people that do want to invest, but exactly like what you were saying, a lot of those people that want to invest, they might not have the same values as you. Situations in in their lives might change, and they might be like, "Hey, Chris, like, hey, Philip, I need my money now,"
Mm-hmm.
but it's not in line with the original agreement, right? And if you're in the middle of the deal, you haven't even refied or you haven't exited, what are you supposed to do? So
Exactly.
he was basically telling me the more people involved in any particular deal, the bigger the headache.
Mm-hmm.
You're dealing with more people, and this is true for basically any business. If you're dealing with someone that's giving you like 50 grand, and this is the only 50 grand they have, they're gonna be
Mhm.
calling you every single day.
Mhm.
Yeah.
But if you're dealing with a guy, and I'm sure you've seen this as well, you're dealing with a guy or a group of people, and they're putting like forward like $2 million, right? Then as long as the numbers pencil out, then they might not call you much more than like a quarterly check-in or something like that. So yeah, so I think that you guys are on a very, very good path with being as analytical as you guys are. I've seen so many, at the same time as following you, I followed maybe about 100 other investors and investment teams. And I've seen so many people fizzle out because they're trying to scale as aggressively as possible. They're going out and raising capital. We actually were supposed to talk at an event, and we just backed out recently. I won't say anything else about it. But I think that you might have seen this on Instagram too, that group of investors, some bad stuff happened. And yeah. So yeah. And this is what we've seen with like a lot of different groups that just go like as bullish as humanly possible.
Scaling too quick.
Yeah. So going with the left side adventures, bringing everything back is really cool. So you were saying that I think two very interesting streams that we could, take this thing. I guess the first one is going from it was just you and 2 other partners, right?
Yeah.
Okay. So 3 partners and then bring in the first JV. Because I'm sure some of the people listening to this podcast are in that exact situation where they might want to bring outside capital. What have you found? Has it been like kind of relatively the same, or have you found that it's like way more challenging?
I think that's a good question. Like I would just say we're still like in the learning phases of things, obviously. Like we've only been investing since 2019, 2021. It's our first joint venture. It's a lot of learning mistakes or just learning like aha moments as well, whether it's trying to navigate, hey, like the JV should have been set up this way, or we should have further consulted with lawyers or accountants how it should have been set up because of these tax implications down the road. And then so I think one of the things that we've learned, or I've kind of learned and reflected on, is like it's better to actually go bigger for a lot of your deals. So why have, for example, a JV with a money partner where you're bound by a joint venture agreement? Why not just set up an LP structure, or why not set up a corp? Obviously, corp is going to be more expensive to maintain, but why not set up like a limited partnership so that it's cleaner, it's easier? I think that's like the main thing that I've kind of like reflected upon with the recent JV that we've done. It's better to just get everyone together. You and I are there's going to be 3 GPs. We're going to have 1 or 2 or 3 LPs, and we're going to go after bigger deals, get like 15 units all in one thing. If you can continue to build that portfolio, you have like those partners who are like not wanting their 50K. They put in, let's say, 100K, 200K, and they're okay with you just recycling that and getting like a quarterly or annual report. So,
no, that makes sense. In the with anything in life, I guess it's everything's a learning thing, right? So, the good news is that you're learning this very quickly. It seems like just after your first JV, you're already strategizing on how to do it even better. With the new structure, do you foresee challenges with that as well, with the general GP and LP?
I think it would probably just be like new learning curve. Essentially at that point, like what if one of the limited partners was, they want to take their money out? What if
That's true.
You have to find someone else? Or what if like something particularly happens? I think one of the benefits of like having a team-based approach, when we look at ourselves compared to like other investment groups, even though you have less of the pie, it's like at least there's 3 of us to deal with the issues, 3 people to kind of have different perspectives, just like you and Chris and Rodby are kind of like a duo, Batman and Robin, figuring out different perspectives. Maybe Chris is on vacation, Rodby's like closing deals, right?
It's always like that.
Yeah.
But I'm not on vacation. I'm just at home and Rodby's closing deals.
Not at all.
Every time he calls me, I'm like,
But
someone save me.
That is a very good point, Philip. You never really know until you're actually in that situation, right? With your, if you don't mind me asking, with your investments, what is the play there? Is it just basically long-term holds while getting tenants in, or what's the approach there?
Yeah. I've been thinking about this a lot lately because like when I talk to other realtors or other people kind of like, and everyone's going to have a different cup of tea. Everyone's investment strategy is a little bit different. Some people like flips. Some people like development. Some people like stocks, equity. Nothing wrong with that. Some people like dividend stocks. Some people like bonds. Different vehicles get you to the same destination. Some of them will get you there faster and better. But when I think about it, like our preference, our investment vehicle is really multifamily properties that we buy and hold for a long period of time.
Mm-hmm.
As you guys know, there's 5 ways to make money through real estate. Cash flow, that's like the most common one that everyone's like, cash flow, cash flow,
Yep.
cash flow. You can retire off cash flow. That's somewhat true.
Mm-hmm.
But there's also like equity pay down,
Mm-hmm.
right? You don't get
Yep.
this from development, right?
Sure.
Passive appreciation, you don't get that from development and
Mhm.
flips. Forced appreciation, you get that from flips.
Yep.
And lastly, tax benefits. You don't get that as much, generally speaking.
In Canada.
Yeah. And in Canada, I'm not sure about like the development landscape, but like
Mhm.
obviously you might be holding that in a corp, saving some of the profits, but the tax benefits you get from buying and holding something long term is different than a flip or a development project.
Mhm.
So our strategy is to basically acquire lots of properties, build up a lot of assets under management, continue to pay it off so it can be debt free if you want, get more cash flow. And then the key is like if we want an injection of capital, you sacrifice the cash flow for a refi and just take
Mhm.
out that money tax free, quote unquote.
Yep.
Right? You don't have to report that. You can report the interest as an expense. So the goal is to really just build up assets under management to eventually 5 mil, 10 million, and then figure out what we want to do. And then we have a lot more cards to play with,
Mhm.
a lot of more options to deal with. Like you
Mhm.
could refinance 200K, put that into someone's passive investment
Mhm.
development project, get a good ROI on that and be completely passive. Or you can just live off the cash flow, or you can take that, buy another property. A lot of different things that we're kind of thinking about. And this is what I bore my wife with at night.
No, it's quite interesting to hear.
For us.
Yeah, no, absolutely.
Yeah.
So what
Yeah.
you're saying, Philip, it seems like at this point in time, again, correct me if I'm wrong, you want to keep your options open.
Mhm.
One thing is for sure, you definitely want to make money. But from now until you get to that point with $10 million of assets under management, you want to keep the doors open.
Yeah, trying to keep it open. Like we're all trying to find like what is the best thing to do with our money,
Mhm.
right? Are there better opportunities? And the main thing, especially transparently, like we're 32 years old. Like
Yep.
all of our partners are 32. We're all probably in around the same
Mhm.
age range. And so like our goal right now is to grow.
Mhm.
Take the money we make in our 9-to-5 jobs to just grow it. And then at some point it may be just like relax and just stabilize.
Enjoy the fruits of your labor.
Yeah, and if we get
Mhm.
bored at that point, it's like grow it some more.
Yeah.
I heard recently like an investor kind of talk about like, going through phases where he's just going buck wild for 5 years, acquisition, and then stabilization, pay off
Mhm.
as much debt as he
Mm.
can, go back to acquisition mode.
Mm.
Really kind of like just enjoying life during those periods, because you may get to a point where if you just grow all the time, and then you stop because you've reached your goals, then you don't have the fun anymore.
Exactly. At that point, what are you doing it for anyways, right?
Maybe buying a place in Cancun and just
Just living off the cash flow, right?
No,
Yeah.
that's true.
Yeah.
No, I remember, Chris, you were mentioning, I can't remember who it was exactly, but there was a builder that sort of had a similar mindset, investment approach, but on the building side. So he would build like, sorry, it was my other friend. He would build like crazy. And then
You have other friends?
I think so. I'd like to call him my friend. And then after that, he would basically enjoy his, the fruits of his labor,
Mhm.
and then start again. But again, at the end of the day, I guess part of it too is a lifestyle choice,
Yep.
right? So in terms of how I see things, I would definitely take the same approach. I'm more risk averse as well, and it's
Mhm.
more consistent this way. I'm sure there are other investment opportunities that have much of a massive ROI,
Mhm.
but they also have way more risk as
Mhm.
well, right? So for me, I'm out in those cases.
Yeah.
I think this is definitely the way to go.
Yeah,
More
100%
consistent.
agree with that. I think trying to go like balls to the wall with everything,
Mhm.
especially in the investment space, is not the way to go. With a business and with your own personal income, sure, try to get that as high as humanly possible. But in terms of investments, I don't think it makes any sense. Or else you're literally just at a casino. And
Yeah.
if you're talking about real
That's true.
estate, it's
A lot of
not the
money.
same as just buying like, you know, $10,000 worth of Dogecoin, right? Like,
Yeah. Oh yeah.
because you're
Yeah,
not
yeah.
you're not qualified for any loans. You're not hurting your credit score at all. There's way too many moving parts in real estate to not have like a left-sided approach to the entire thing. Because this is a vehicle that can make you very rich or a vehicle that can make you very poor too. Yeah. So I do have a question for you, Philip, and this is something that Rodby and I talk a lot about, and it's the cash flow versus appreciation thing. So, uh, like, you follow a lot of investors as well. You listen to a lot of stuff and read books and whatnot. There's so many different, opinions about this.
Yeah.
Where in an area like where we live in BC, if you try to get a cash flow play, maybe you're also buying into a market that really doesn't have much appreciation value, or you're buying like a leasehold, where the rentals are similar to to the other types of properties, freehold, but your acquisition is maybe 50% of what the freehold is. But that property might be losing 2% a year, just on appreciation. But I've also seen people that might put down, let's say, I don't know, like $100K for 2 homes in Detroit. And they're trying to make $500 a month from like, what's
It's a 6% return, 500 times 12,
Yeah.
6,000 a month, 6%. Yeah.
Yeah, and it's like, but you're locking down $100,000, when you can just put that into GIC and literally get a 6% return as well, without any risk, and you're not dealing with a Section 8 too. So what's kind of your view on this? Because it's hard. Like even if Rodby and I, let's say, were to invest in something, it's really hard to figure out which way to go, because especially if you're a young person and you already have like a good amount of like personal income, like, do you even necessarily want to add extra cash flow on top of that? You're increasing your tax liability as well, just for like a couple $100 a month, and one capex event and it wipes you out for
that's
years.
True. That's true.
So it's kind of like which one do you even go?
Yeah. I think my personal opinion, if we just zoom out a bit, is like cash flow markets are probably going to be like the market where you're not going to hurt yourself the most, especially when you're trying to practice and figure out like, how do I invest into these multifamily properties? It's going to give you all the good reps so that you're familiar of how to invest. You can build like the good repetitions. You can figure out what's a good investment, what's not. And you can scale a lot faster in these places, and the capital that you need is not as high. I think it's interesting when you look at Canada though, because Canadian markets, aside from my bias and general knowledge of, let's say, Manitoba or the prairies, like the prices don't really go up there.
No, Edmonton too.
Right? Edmonton, doesn't go up. But when you look at like most major Canadian cities, they generally will go up in 10, 20 years. So I think Canada versus States, slightly different beast when you look at a Detroit, or you look at these smaller Chicago areas where prices don't go up. I think cash flow can be something, it depends on what your investment goals are. For example, someone who's a doctor or a lawyer, or even a real estate professional who makes 100K, 200K, 500K a year, they probably don't care about that cash flow side of things unless their goal is to create what I call like a mini doctor who works for themselves in that passive cash flow. So doctors, like when you tell them like, hey, you can make $500 per month of cash flow or $1,000, they don't really care because they're making $500,000 a year. But when you say like, hey, wouldn't it be nice if you just had a little doctor working like day in, day out? You're not actually working. It's just a mini version of Dr. Rodby at a hospital, and that pays for your kids' tuition, pays for your kids' like, skating lessons or whatever they want. Then their frame of mind changes a bit, right? Because they don't care like we do about like, hey, you can make $1,000 of cash flow a month. So end of the day though, appreciation, like Vancouver markets, large markets, appreciation is where like true wealth is built. So that's kind of like the end of the debate, and kind of like that's why we like kind of like the middling markets. If we can break even in an appreciating market, I think that's like fantastic.
Okay, I totally agree with that. Yep.
But if you're putting in at that point like half a down payment, 50% to break even, then that's not a good use of your capital.
Not at all.
Now that the ROI or that cash on cash return is diminished. And just the fact that if you think about people who bought properties, why couldn't we be born 5 years younger?
Yeah, seriously.
7 years younger, 6 years younger? Those people, I have friends who own, they didn't have to go as in deep about real estate investing as me and my business partners or that anyone kind of has, but they own 3 rental properties, 4 condos. Because those were the days in 2015, 2017 that you can buy and you were cash flow neutral for a condo. And since 2017 to 2020, even now, it's more than doubled.
Yeah.
I remember a River District 1-bedroom condo was $300K, 2-bedroom was $350. By the time it completed, it was $700K, $800K for 2-bedroom.
Yeah.
Right? So all my friends who are older, they don't really care about this stuff because, again, they already bought 4 or 5 condos just because they were even realtors or teachers.
Just the timing.
The timing.
So lucky. So lucky. My aunt was actually telling me that back in the 90s, with the whole leaky condo thing before rain screening, one of her friends actually, I believe, was moving back to Hong Kong, and she offered to give her condo for free.
Yeah.
Just take it off my hands kind of thing. And she said no, because back then condos were a death race. It was a death trap for your money, basically. Leaky condo, you would be constantly incurring cost. Your insurance would be insane. So she said no. But that condo now is probably worth $600,000-$700,000 if she held on, right? Yeah. So if only we were born 20 years younger, right? I always cry that I was 9 years old in 2004. I could have, if only I was 20 years older, I could have, gone the first swing and then bought in 2009 and then just kept going, right?
Yeah, but I think that's the fun about real estate. 10 years, 20 years down the road, who knows? A condo could be worth 1.5, could be worth 1.5 mil.
I agree.
Same thing with the houses. Everyone bought houses before for $500,000-$600,000, turns into 2 mil. I heard someone say everyone who bought a house hit the jackpot and blah blah blah. But I think it's kind of the same. We'll see. It's generally the same story that will potentially play itself out in the future.
I think so too. And if anything, it might be a blessing in disguise for us, right? Because we're doing this in terms of timing. Yes, the older generation, they were lucky in that regard. But for us, we're lucky that we are this far into it and are going even further, right? So we might even benefit, in my opinion, more than they have, right? As long as we continue. Yes, it is more hard work, but it is what it is.
I think everyone has their own hard work. Those people back in the day, parents or older generation, or just people 5 years older, they were stingent and tight with their money. They made good money. And so my parents were immigrants. They saved nickel and dimed everything, didn't spend money on anything, and they bought a house. So that's exponentially a lot of work. Our work is different. It's study this, figure out this, build relationships.
No, absolutely.
Climb the property ladder. Yeah. Back then, the property ladder wasn't even really a concept.
Yeah. Listen to YouTube, listen to books, find mentoring.
Listen to a podcast.
Yeah, exactly. Our views are just going to skyrocket after this.
Oh, actually, another question for you. This is kind of going back to the left side adventures thing. So you guys have, I don't want to say you guys have gone through a whole real estate cycle, because we haven't since COVID. But you guys started in 21. Market was insane. A lot of people were buying out of province. A lot of people were trying to buy multifamily. Rates were non-existent. At that time, when you guys were running your numbers, were you having the conversation of, hey, this will switch at some point? Rates will go up. What were the conversations?
What was happening at that time
for you guys, for the internal team?
At that time, the numbers didn't even pencil out.
Really?
At that time, and that's why a lot of investors were spooked to the numbers are not ever gonna work out. And so even at commercial loans at 3%, which meant like residential loans are at like 1.5. The numbers didn't pencil out because like the rents were just not supporting it at that time. So like once we started closing and we renovated one unit, went to the next, because we did a phased approach, don't do them all at once, test the market, rents went up. Renovate another one, test the market, rents went up. We're like, what the hell? The numbers turned out to be a lot better than it was. And then because like we pretty much bought 2 properties in 2021, like so close within each other, all the milk was squeezed, or like all the lemon was squeezed out of the lemon juice was whatever. It got squeezed out. So we didn't really look at any properties for that time period. And then when we finished refinancing and buying like property number 3, that's when we started to reassess, hey, like rents have gone up. Interest rates have also been going up, and they will probably seem to like continue to go up. So at that time, basically to answer the question, which was, again, what was the question again?
Like just from like how you guys were looking at properties back then with everything going on to now.
Got it.
Is there like a difference in approach, difference in mindset? Yeah.
So even like when we bought properties 1, 2, and 3, we at that time were reading like a book called like Recession Proof Real Estate Investing, right? And they were like, stress test your properties, do this, increase the rates by that. Even if you took that into consideration, like they said, increase it by 1 to 2 points, like it increased by 4 to 5 points.
Yeah, exactly.
So it didn't really work in that favor. I think we underwrote the deal really nicely. I think we paid a really good price, and we got bailed out by the fact that you live in, we buy in New Brunswick. Rental laws were really favorable for the landlord, and the prices just kept rocketing up. So it's still that same approach where it's like, hey, I don't think we do stress test as much anymore, but when we're underwriting deals, what's the worst case? What's the likely case? What's the best case scenario? And lately we've been doing that across the board, whether it's rent, expenses, renovations, how long it takes for timelines, even projecting like how much is our self-storage space going to be renting out for. And then this is beneficial when working with a JV, because it's like, hey, this is the worst case scenario. This is the best case. This is the likely case. Is it okay?
A lot easier to present the information.
Yeah.
I guess what you do is the like pro forma income statements and whatnot. That way it's very clear. You can see the numbers. But even at that point, I would assume there's a lot of speculation, right? Nobody can really tell the future, but a lot of educated approach to coming up with those numbers.
Yeah, as long as you're not coming up with like outlandish rents that are not like realistic, and the rent growth, and you're not factoring in like, oh, the rents are going to continue to skyrocket at 4% a year, 5% a year. I think like the iffiness comes with like, let's say someone's quote for a job, structural fixes or like renovations happening, or like there's like interior drainage kind of issues we have with one of our buildings. They say like it should be this, but sometimes it could be double, right? So that would be like the worst case scenario,
right?
And so like the better we get at it to figure out how much these things cost, and the better our team gets in terms of like when we're buying a property, they should look at these checklists. Hey, you didn't check out, for example, the electrical panel. Looks like we don't have enough amps. If we wanted to add an extra one, that's going to cost us this much more money. And these are things that like as a long distance investor, we don't have the benefit of. I would love to tour 100 properties in the current market to just get a feel for everything and just ask millions of questions to property manager, contractor, realtor, just to figure everything out.
Yeah, I know. Going to that many properties, especially if it's out of the province, is not
and
really
multifamily too.
Yeah,
it's not just a singular property.
Yeah, you walk through 1,000 properties, you're probably gonna be good, and you figure everything out.
Yeah,
right. So I'm just trying to figure out like how do we navigate those scenarios. Like you really got to train like your team to like look out for the right things, and if they're not investor focused, they obviously don't look at the right things.
Yeah. No, I feel like
we see that a lot in our industry.
Exactly. With a lot more of the amateur investors, they definitely don't do the worst case, most likely, and best case scenario. Even though in in the realm of investing, that's something that you have to do,
Mm-hmm.
right? And then the stress tests as well, especially in a market that was as volatile as it was during COVID. I feel like a lot of people that were not that experienced missed out, and that's why in parts of BC, there's a lot of investors offloading that because they can't make the payments or they can't qualify, right?
Mm-hmm.
For
There's a ton of
new
places in
builds.
BC right now with pre-sale.
Yeah.
Yeah.
So I guess besides being very analytical when you look at investments, what other pieces of advice, maybe just one or two, that you can provide to people that want to get started in real estate investing?
I think the number one advice would be probably I've been telling a lot of people is just partnering up with people.
Mm-hmm.
Less of the pie, but it's just also less of the risk.
Yes.
It's just a lot more resources, especially given how capital intensive it is nowadays. It's a lot of capital to go in for a deal like 20% down, 40% down,
Mm-hmm.
and then hopefully pulling some of that money
Mm-hmm.
out. So I feel like you really need that now. And just continuing and just being really stubborn with just educating yourself. All the information is there free. If you want to do free, if you want to pay someone for coaching,
Mm-hmm.
obviously vet them.
Mm-hmm.
But yeah, really just investing into yourself, your education, and partnering with other people is probably the number one advice. Like
Mm-hmm.
me, Johnny, Ryan, no background in finance, no
Mhm.
background in real estate. I'm just like a nutritionist,
Mm-hmm.
but all the information is there for people to take advantage of in
Yeah.
today's world, right?
It's available if you're willing to look for it, right?
Mm-hmm.
And I really admire the approach that the three of you are taking. It seems like you're very conservative, very risk averse. It's something that I would say I'm very in line with as well. And I think it was you, Chris, that mentioned in previous episodes, building wealth, especially in real estate. It's not about the massive swings.
Mm-hmm.
It's about incrementally increasing your wealth, right?
Mhm.
That's what really builds the wealth over a longer period of time.
Mm-hmm.
Mm-hmm.
Yeah, it's like the Warren Buffett method.
Yeah, yeah. No, it definitely makes a lot of sense,
Yeah.
right? You don't want to gamble all the money that you've worked so hard for,
Mm-hmm.
right? Especially at this time. But in terms of other questions, what else did you have in mind?
So I do have one.
Mm-hmm.
I do know that you you network with a lot of different investors, some developers and stuff like that as well. So if one of our listeners are in a situation where they also own multifamily, maybe they didn't pencil their deals too well, and they might be cash flow negative right now. Interest rates have skyrocketed, and now their loans are significantly higher, but maybe their rents weren't that high. Because I do know that multifamily is much more of a business than buying like a single family or a duplex or something like that.
Mm-hmm.
What would you recommend that listener do to potentially increase the income of the property without, kicking everyone out? And let's say rents were optimized, and they have like a washer dryer in there as shared, and they have storage spaces and parking and stuff like that.
I feel like one of the issues is like you really just had to buy it right.
Mhm.
So like if you bought in Ontario or BC, you can't increase the rents.
Mhm.
Like you can only
Yep.
increase it 3.5% this
Yeah,
year,
yeah,
Mhm.
yeah.
right? So it's
much.
tough, right?
Mhm.
I don't know how like Ontario investors kind of make it work. I'm sure they make it work somehow. Their pro formas are a little bit different.
Mhm.
It's different too. Like if you're investing in New Brunswick or Alberta, you can jack the rents up as high as you'd like. But if it's already at the highest, what do you do, right?
Mhm.
So at that point, I guess what you're kind of suggesting is like looking at the property. Are there any? Can I add any more value to that
Mhm.
property?
Yeah.
Can I update it? And then at that point too, like the left side approach is like running your numbers. Like at what renovation price does it make sense? Like if you're spending
Mhm.
$50K to increase it by, let's say, $100 a month,
Yep.
probably not a good investment.
Mhm.
So at that point, I think a lot of people I've seen, they're just reassessing their properties. And is this in a market that I see that's going to appreciate? Are the rents going to continue to go up? How negative cash flow am I? And do I need to be in the red, or do I need to be in the green, for example? Like
Mhm.
most people who buy in Vancouver, they don't care about cash flow because they're in it for the long term
Mhm.
and they're pretty rich,
Mhm.
right? They don't care that they're bleeding $500 a month. So with the people who I see that do care, it's like, hey, I bought in this little area. Property prices have gone up. I've done my forced appreciation. I'm just going to take out my 200K of profit, and I'm just going to wait for a better time. So I think like you need to look at it from that perspective. Is my money like good where it's at, or should I just like liquidate, sell, and then figure out what I want to do with my property? So I have a couple of friends out in Ontario, smaller areas. They had 4plexes that they bought all during COVID, and they're like, you know what? I'd rather just gonna take my profits off the table, and when the time comes, I'm gonna find a better investment.
Makes sense. Cut your losses and just wait for the next opportunity.
Take your wins.
Take your wins. Exactly.
Right?
I mean, if you already made 200K on it, why not, right?
That's true.
Yeah. And so like the people who are buying in little cities or single family homes, they're already kind of just like bleeding 200-300 a month. They don't foresee those smaller cities increasing in value as much. Especially if you're growing your portfolio, they already have 20 to 30 doors, which a lot of my friends do have, my online friends. They do have. So they're just like, yeah, I'm just going to trade up my monopoly pieces and I'm going to buy bigger properties. Why have 8 single family homes when I can just go buy like a big badonkadonk later?
Yeah.
So
makes sense.
Cool. Okay. Well, I think we're really coming up to like the maybe 50-ish minute mark. You are actually our longest episode, which I'm so happy about because I've learned so much.
Me too.
From this one.
It's really a treat for us. Thank
you. Looking in the future, maybe let's say 5-10 years down the line, where do you guys want to be? And like what? Because I know you were saying like about lifestyle and stuff like that. So
loaded question.
I know.
Loaded questions.
We can keep it to a short loaded question.
I forgot like exactly what our specific goal like was in terms of like assets under management, but definitely within 10 years, I would say like within 5 years, we definitely want to retire our significant other through real estate and leave it to them if they want to work. You know, cash flow, generally speaking, $5,000 a month each. That would just get them by, and obviously that's like financial independence. Financial freedom is like living however you want. That's like a FU money. I do whatever I want whenever I want. But independence is pretty much like $5,000 a month. You can get by with one person working and the other person making $5,000 of cash flow, right? Through real estate investment properties. So that means as a company, we needed to make like 15,000, just divide by 3, right? In 10 years, I think it'd be good for us to reach that financial independence number to retire all partners and all their spouses. And then if they want to work, they probably will work. But I think these are kind of like the outlandish kind of goal. Kind of just set it high and we'll see how that happens or if that's even possible. So whatever the assets under management will look like, but that's kind of like the cash flow goal that we kind of have in the next 10 years.
That's amazing.
That is a great goal. We got to work harder, Chris.
Seriously. I make $1,000 a month right now. Okay. Well, do you have any more questions for him, Rodby?
That's all the questions I have right now. Thank you for answering all of our questions. I'm sure that our listeners are going to be really
appreciate this.
Yeah, they're going to be very happy with all the wisdom that you've shared.
Now, Philip, just to end it off, if you could leave like one tip to someone that wants to invest in the real estate, reach a financial freedom, like a 1-sentence, 2-sentence tip, what would it be?
Do I have to do 1 or 2 sentences?
Whatever you want.
Sentence number 1, listen to Chris and Rodby.
Oh, yeah.
If you're in the Vancouver market. Sentence, what were we talking about again? Sentence number 2.
Just any tips.
Any tips
for anyone that wants to get into real estate investing.
Just be super, super consistent and just put your head down and don't give up. Just keep piling through. If you're feeling tired, keep piling through and just stay focused on your goal.
Cool. Well, I think that's a great place to end it off, right?
Absolutely. There you have it, folks. Thank you so much, Philip, for joining us. This was a great episode.
Okay, we'll see you next time.
Thank you.
That wraps up this episode. Thanks so much for listening. If you like the episode, leave a review and follow our socials linked in the episode description. Make sure you share this episode with someone you think would get value from this podcast. We'll see you next time.